Hello and welcome to this session in which we will discuss intangible assets. First, we need to understand what is intangible asset. Well, intangible assets are assets. What is an asset? Something that's going to provide you some benefit, but these assets lack physical existence. Those are non-physical assets. It means you cannot touch them, you cannot see them. Versus we have what's called tangible assets. When you think of tangible assets, think of something we call an accounting property, plant and equipment, like machinery, computers, furniture, chairs, building, so on and so forth. Those are tangible assets. Tangible assets, they don't have physical existence. Well, however, they are quite valuable. And in today's knowledge economy, intangible assets represent a large portion of the company's asset. And they do provide future economic benefit. They are actual assets. So these assets are important from a taxation perspective. Why? Because companies purchase those assets. And when they invest in them, they can have a tax deduction. Remember what I said, they purchase them. Now, sometimes those assets are created internally. Well, when they are created internally, what can we do? Well, to come up with a patent. So what is a patent? Let's assume we end up with a patent. Patent is a secret formula, a special way on doing something. It's engineering a product. Well, you patent it. You get a protection against that patent. For example, you invented a medication, a drug. Well, you file for a patent to protect that drug. Well, in order to get the patent, you might have spent billions of dollars, and pharmaceutical companies spend billions of dollars with a B. What happened to that money? That money is called research and development, and that money is expense because it's not an asset. Here, what we're referring to is assets that we purchase. When we purchase the asset, initially it's recorded at cost, then we are going to take a deduction for that intangible asset. And this is what we would learn in this session. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Let's take a look at some examples of intangible assets, starting with goodwill. This intangible asset is a little bit unusual. Let's explain it. Goodwill is created when one company, for example, company A, purchases company B. So when they purchase company B, they look at company B's assets, fair market value. Then they look at their liabilities, fair market value. And let's assume the assets are worth $1 million and their liabilities are worth $800,000. The difference between asset and liabilities is the company is worth at fair market value, what we call the net assets, is $200,000. And here comes company A and pay $350,000 for this company. So they paid an extra $150,000 extra above the net asset. Now, why did they pay this amount? Well, it could be because the company reputation, it could be the customer relationship, it could be the brand strength, and all these good stuff, they are not reflected in the 1 million. So when they purchase the company, since they paid an extra 150, they have an extra 150 of assets. This is called goodwill, and you learn about this in your advanced accounting course. What do we do with this goodwill? We are going to amortize. What does amortize? It means deduct for tax purposes. So we can deduct this extra money that we paid in form of a goodwill. Trademark and patent, if we purchase them, those are legal rights granted to the business to exclusively use certain unique creation like brand name, logos, invention designs. For example, I hope you are all familiar with the Apple logo. Well, Apple cannot amortize this logo because they did not purchase it. But I'm just showing you a trademark example. But let's assume someone purchased Apple computers and they pay for this. They're going to value this separately. Then if they value it, they can deduct this. Copyrights. Those are protection given to creators of original work like books, films, music, and software. If you buy them, guess what? If you buy a book, a film, and you're using it for your business, you can amortize that cost. Franchise right and licenses. Like if you open a McDonald's, you pay a fee to use the name. Well, it's rights granted to a business to operate under a franchisor brand or to use certain licensed product or technology. Well, guess what? You pay for those assets. You pay to use them. They are intangible assets, but you can deduct them. Customer list and relationship. The value of established customer basis and relationship can be considered an intangible asset. Sometimes you might buy a list of customers, just a list, emails, phone number, addresses, so you can market to them. Well, that's an intangible asset. Software and databases. Those are important assets, but those are intangibles. You cannot see them. The software, it's a code. Nevertheless, you paid for it. Because you paid for it, it's an asset, you can deduct it. Now, the government has this section 197, and don't confuse this with section 179. Section 197 amortization is to amortize intangible assets. What are intangible assets? Again, assets that lack physical existence. I showed you some examples. Amortization means it allows you to take a deduction, a tax deduction. And why is that good? Tax deduction can lower your taxes. Why is that good? Lowering your taxes would lower your tax bill. You'll have to pay the government less because you can take deduction. So this section allows taxpayers to recover the capital cost of certain intangible assets through amortization deduction over a fixed period of time. So let's see how the amortization happen. So the eligible assets, we kind of list some of the eligible assets. Amortization, over how long you can amortize them. Section 197 allow you to amortize them over 15 years, regardless of the actual useful life of the asset. Some assets might have a different useful life. You are allowed to deduct them over 15 years, starting with the month that you put them into place. So be careful, begin with the month of the intangible is acquired. Because on the CPA exam or on your exam, they might trick you, give you a date, and you may not pay attention to that. Which method would you use for amortization? We would use the straight line. Pretty straightforward. Hopefully we all know what the straight line is. Take what you invested divided by 15, and this will be your yearly amortization. Now, if it's not yearly, you'll have to multiply this by a prorated amount, which we'll see in a moment. Now, if you are told the asset has an indefinite life, it's non-amortizable, it means we cannot amortize it. We cannot make a deduction. In the absence of that, intangible assets are amortized. Let's take a look at an example from farhatlectures.com. On September 1st, 20x3, Noah purchased a business. Of this purchase price, $60,000 was allocated to a trademark. So they bought a trademark for $60,000, and $375 is allocated to goodwill. We talked about goodwill. Calculate Noah's 20x3 section 197 amortization deduction. Well, first Noah will take $60,000 divided by 15. That's his yearly amortization for this asset, for the trademark. But since we purchased this on September 1st, we're going to multiply this by 412. Therefore, for the trademark, we were going to take $1,333.33, assuming my computation is right. For the goodwill, we'll do the same thing. 375 divided by 15. So this is the yearly amount, but we are not year X3. We started in September 1st, therefore we have to multiply by 412, which is September, October, November, and December, which will give us an amortization of $8,333.33. Total of amortization expense is $9,666.66. This should be a period, not a comma. So this is how we will compute section 197 for amortization of intangibles. What should you do now? You want to go to Farhat Lectures, look at additional resources, possibly MCQs, possibly lectures, whether you are studying for your CPA exam, enrolled agent, or accounting student. Invest in yourself. It's worth it. Good luck, study hard, and of course, stay safe.